Hey there, I'm Dylan Lewis from The Motley Fool. In this FAQ video, we are breaking down market capitalization and explaining how investors can use it to help them identify companies to invest in. The finance and investing industry loves to come up with more complicated ways to say pretty simple things, and market capitalization is a perfect example of that. You'll often hear it abbreviated as market cap, and really all this number does is tell you what a publicly traded company is worth. To find it, just take the number of shares of stock a company has issued and multiply it by the current market price of the stock. So if a company has issued a total of 20 million shares and each share is valued at $20, then the company's total market cap is 400 million. You can do this math on your own, but if you go and search any publicly traded company, the market cap will be listed right there, saving you the hassle. Market cap is one of the best measures of a company's size, and it can tell you a lot about what to expect if you're buying a stock. In general, large companies tend to have more stable and mature businesses, and having proven themselves over time and weathered difficult business conditions, they're able to emerge even stronger. However, the growth prospects for these large companies tend to be more limited because they've already grown so much and see so much of the opportunity in front of them. By contrast, smaller companies have a lot more room to grow. However, smaller companies tend to be riskier and younger with business models that haven't been proven out over time. Their odds of failure are significantly higher than those of the more stable large companies. Here's a quick breakdown of the way market capitalization ranges are often segmented and discussed within the stock market. We're going to explore these categories more in depth, but first, let's just appreciate how wide a spectrum we're working with here. A large cap company could be 200 to 4,000 times the size of a micro cap business, and some mega cap companies are worth over $1 trillion. Large cap stocks have market capitalizations of $10 billion or more. Most of the best known companies in the world are large caps, and some investors break out stocks with market caps of more than 200 billion into a separate category, mega cap stocks. Most large cap companies have mature businesses and generate substantial amounts of revenue. They often earn significant profits and have a considerable market share within their industries, making them leaders in their fields. They're also more likely than smaller companies to pay sizable dividends to their shareholders because their businesses tend to produce greater amounts of available cash. But large cap companies have already gone through their period of maximum growth. As a result, even successful large cap companies that pay healthy dividends and whose shares have gone up in value consistently won't always be able to match the massive returns that smaller companies can achieve. The trade-off is that investors enjoy more stability, and often market-leading companies continue to win. They might just not put up insane growth rates. Mid-cap stocks have market caps in the range of $2 billion to $10 billion, occupying the middle ground between large and small cap companies. Mid-cap companies are large enough to have made considerable progress in building up successful business models, and that gives their investors some stability and protection against future challenges that the company will face. However, they're small enough that they still give investors a longer runway for future growth than a large cap stock. That said, mid-caps also face the difficult task of trying to catch up and surpass their larger rivals in their industries, and they often don't have as many financial resources to do so. It's important when investing in mid-cap stocks to know their history. Some mid-cap companies are still in their high growth phase, while others have reached their full potential in a relatively small, niche industry of limited size. Still, others are older companies that used to be large caps, but have had their businesses lose steam. Any of these can be good investments under the right circumstances, but they have very different characteristics in terms of growth potential, dividend income, and valuation. If you're looking in the mid-cap space, ideally you're buying companies that are still posting impressive growth and gaining market share. Those are the kinds of businesses that ultimately become large cap companies and reward shareholders along the way. Small cap stocks have market capitalizations of between $300 million and $2 billion. Some people also include within this category even smaller companies with market caps of 50 million to 300 million, while others put those tiny stocks into a separate group called micro cap stocks. Small cap companies tend to be younger than large caps or mid caps, and they also have a much shorter operating history as a business. Small caps often have considerable growth potential, but investors in small caps face a lot more uncertainty about their future. In many cases, small caps have to upend much larger competitors in order to stake their claim within a given industry, and for every small company that succeeds, many fail. Over time, small cap stocks have historically produced higher average returns than large cap stocks, but their performance has been more volatile along the way. That requires small cap investors to have a greater risk tolerance than those who concentrate on larger stocks. Those with long time horizons can typically weather the ups and downs of small cap stocks and therefore have a better chance of enjoying the reward of greater returns. Most investors find that having a diversified portfolio that includes large cap, mid cap, and small cap stocks lets them tailor their desired return and risk levels to their specific wishes. If you want your portfolio to be more stable, then you'll want a larger allocation to large cap stocks. Those who want greater amounts of current income will also typically gravitate to large cap stocks because they tend to be the dividend payers. By contrast, if you don't need much income and your primary goal is to have your portfolio grow as much as it can over many years, then you'll likely want to make larger investments in small and mid-cap stocks. Market cap helps us categorize companies, and it also helps us compare them apples to apples. Say you have two companies, Dillon Enterprises and Lewis LLC. Dillon Enterprises has a stock price of $30 and shares of Lewis LLC trade for $20. Now, which one is the more valuable company? You can't know without also knowing how many shares each company has outstanding. Say Dillon Enterprises has 10 million shares outstanding and Lewis LLC has 20 million shares outstanding. Lewis LLC is actually a bigger company, even though its share price is lower. It just happens to have sliced up ownership of the business more ways. That's why market cap is a far better indication of where a company sits than share price, and why it's important to know the size of a business you're buying before you buy it. If you're looking for more awesome investing content, check out our free investing starter kit. It covers everything you need to know about investing, and it has 5 free starter stocks to get you going. We want to know what stocks you are interested in. Drop them down in the comments section below, and be sure to hit the thumbs up button to like the video and subscribe to get more content like this from The Motley Fool. Until next time, Fool on.